the chance of rate cuts just got reduced again. Hi everyone, Yinan here. So we're all watching the market, hoping that there's more rate cuts in 2025 to help save the GTA real estate market. And that seems like the only possible savior for our current slow market now. But we recently had a few new data points that came out, including inflation data and unemployment data that seems to be pushing this hope into the opposite direction. So let's take a look. So on the screen, you'll see that this is the latest Canadian inflation rate. In June, we're at 1.9%. So this 1.9%, as you can see, it is higher than the previous 2 months, April and May at 1.7, and we're at 1.9. Still under the 2% target rate by Bank of Canada, but this increase direction is not what we want to see, right? Because we're all worried about the macroeconomics, how the tariff from the US may impact Canadian inflation, and if that causes inflation, then it will be harder for Bank of Canada to drop rates, right? Because we want to keep inflation stable. So this increase is definitely not a good sign directionally. And if we take a look at the Canada Consumer Price Index, the CPI, CPI basically is the underlying data behind the year-over-year percentage of the inflation. And we can see that June, we're at still a recent high point, right? At 164.4 points. And that is higher than May, higher than April, higher than the last while, right? So this is not good because if you take a look at the past 1 year or past 3 years, like you can see that we're consistently still going up in terms of our actual pricing. And especially in 2025, we're seeing this accelerated increase, right? Our actual price of our goods, and that's driving up the inflation expectation. And Bank of Canada sees this too, and they're also worried that if they drop rates now, what if this jumps, right? And cause inflation to go up to like 2.5, 3, 4%, and that'll be trouble again, right? So because of this, I think Bank of Canada is gonna hold off on dropping rates for a while until they see this trend gets more stable. And if we look at the Stats Canada, there's the core inflation measures, right? We want to look at the core inflation is what Bank of Canada cares a lot about. And you can see that the core inflation, the CPI common, CPI median, and CPI trim, they're all pretty high, right? In June, they're still at 2.6, and it's an increase from 2.2 from earlier this year, right? CPI median increased from 2.6 to 3.1, which is a 6 months high, and CPI trim from 2.8 to 3%, which is still high, right? This is all above the targeted 2%. So because the CPI core inflation is not backing down, so that gives the Bank of Canada even less reasons to drop rates. If we take a look at the actual category of what's causing the inflation, we can see that every category is causing a higher inflation except gasoline price decline, right? But it means it's declining at a slower pace, but it's still a decline. So gasoline price is the only thing that's really helping to save our inflation from going even further up. But if you look at the other categories, we can see overall we're at the 1.9%, right? This is the June number. If we break it down into categories, we can see food is at 2.9%. Shelter, which includes our rental price, right? Not surprising, at 2.9%, quite high. Furnishing, 1.5%, it's not bad. Clothing, 2% higher. Healthcare, 2.7%. That I think comes from demand because we have so much more population in Canada, especially in the big cities like Toronto. These like labor intensive, just taking care of the sheer higher volume of people, makes sense that personal care costs are going up because demand is up, right? Tobacco at 1.9%. So the only thing that's going down is transportation, which is a result of the gasoline price being at a lower pace, right? At a lower inflation. But even transportation has gone from negative 1.3 last month to negative only 0.6. So it's like the effective, slower inflation from transportation, and gasoline prices even slowing down. So you can see it's not a very good or promising story, right? In terms of our inflation to encourage Bank of Canada to drop more rates. So on the other hand, if you take a look at the unemployment rates, okay? So on the screen, you'll see this is Canada's unemployment rate. This is another number that Bank of Canada watch closely, because if unemployment rate is very bad, let's say nobody has a job, then they may want to think about, okay, lowering rates to stimulate the economy to create more jobs. But if our employment rate is good, people are having jobs, then that's less incentive for Bank of Canada to lower rates and risk inflation while everybody's all doing okay on their getting a job, right? So if we want to drop rates, we want to see a higher unemployment rate. But on the screen, you can see June, we actually have a lower unemployment rate. From last month, 7% dropped down to 6.9. Not a big drop, but it's still a drop, right? It's not good, but at least it's not worsening month over month, right? And because it's actually lower than expectation, because expectation is that in June, our unemployment rate should go up from 7% to 7.1%. But it's not. It's actually going down from 7% to 6.9. So because it's opposite direction from expectation, then market reacts differently, right? So that's basically saying that if unemployment rate is actually improving, then why drop rates further, right? So that's the kind of sentiment. And in fact, if we look at the total employed person, right? In June, we have quite an increase, right? The number of employed person in Canada increased to 21,000. So it's actually where we see it's actually going up. We're having more people finding a job. If you see the employment change, you can see that June is actually a 83,000 increase in number of people finding a job. That's good, because the past 4 months we have been saying that a number of people finding a job has been very slow. It's kind of like non-existent, right? So we were talking about that's a sign of trouble. Maybe Bank of Canada should drop rates to help that. But now look at this big increase. No more incentive to drop rates because the economy seems like it's doing fine on its own. Bank of Canada don't need to do anything, right? So that's basically what's happening from employment perspective, so that people are less worried because they're seeing employment market is doing better. And if we take a look at full-time, in June increased by 13.5 thousand. I mean, not the best, but it's not nothing, right? And the part-time, we can see that is doing quite well, right? There's a lot of part-time jobs being created, or maybe a lot of full-time jobs converted into part-time. Either way, I mean, the data, when you break it down, you can start to see still some trouble, right? Like part-time jobs don't really pay the bill. But overall, number looks good. And therefore, from an employment perspective, that's also another reason for Bank of Canada not to drop rates quickly. So now we've seen that inflation is high, so do not drop rates. And employment rate is good, so don't need to drop rates. So as a result, Bank of Canada likely in the near term will just sit on their hands and be like, okay, we don't have to do anything. There's no reason for us to drop rates, right? And that's why you can see from the 5-year government bond, let's take a look at the past 3 months, right? Because we're seeing all these reasons not to do anything, you can see that the expectation for rate drop is less and less, and the actual 5-year bond yield is actually going up, right? As the world is less and less safe and certain, there's all these wars and uncertainty and tariffs going on. People are actually having a higher sense of risk when lending money to each other. So our bond yield is actually going up. And that means our fixed rate mortgage rates are actually going up, right? It's not going down. That's a problem, right? And no wonder from April to July, our real estate market has been tanking in price. People are actually seeing higher bond yields. And if we take a look at 6 months, you can see that January, February, our market was a little bit better because bond yields were dropping. But ever since March, when the whole tariff thing and the election came, people are getting disappointed or feeling less safe about the market or feeling less optimistic about future rate cuts. Bond yields start going up, right? Especially recently with all these news, there's even less reasons to cut rates, so bond yields are going up even further in the recent period, right? So as a result, for the second half of 25, we are seeing some changes in the bank's predictions. Like for example, RBC and Scotiabank, they think that for Q3 and Q4 coming up, right? we're not going to see a rate cut at all. Like our Bank of Canada benchmark rate will stay put. I mean, other banks are more optimistic, like CIBC, TD. They think we can go from 2.75 to 2.25, right? So some banks are starting to say, you know what, there's no more rate cuts this year. Some other banks are saying that we can still have a percentage of rate cuts. So maybe 0.25% in September, maybe another somewhere in October or December, right? So we're gonna have 2 more cuts this year, but not July. None of them is saying that July we're gonna have rate cuts, but maybe later in the year we may still have, right? So, but you can see people are getting less optimistic about a sure rate cut will happen this year. And on the US side, you can take a look. So right now, for July 30th rate cut, we can see that 95% chance we're not going to have a rate cut, right, for the US as well. In September, we can see that there's actually a good 39 or 40% chance that in September, no rate cuts in the US either, right? And there's a 58% chance we'll have a 0.25% rate cut in the US. But this percentage is quite large. Comparing to like earlier in the year, it's almost guaranteed by September we're gonna have a rate cut in the US. But now it seems like that chance has gone down a lot, right? So we can see people are just generally less optimistic about future rate cuts. And as of October 29th, you can see that there's 48% chance we'll have a 25 basis point rate cut, but still a 20% chance of no rate cuts, right? So this is just to show you in general, as of December, then in the US, the majority of the chance will have some kind of rate cut between 0.25% to 0.5% or even 0.75%. But December is a long time from now. This changes all the time. So as a result of these data points, people are having a lesser expectation for rate cuts to come soon, and they're pushing out the expectations for rate cuts further out, right? Not saying there's not gonna be rate cuts, but just saying that people's expectation are pushing them for later and later. So that's not what we want to see, right? As people who own real estate in Toronto, we want to see rate cuts sooner. And last year we saw that when we had those jumbo cuts, we had a better real estate market in October and November. So this year, we've had a very slow first half of the year. We're all counting on the second half of the year being a stronger market. However, we're not seeing the stimulation that the economy needs to have a stronger market in the second half, right? So especially with these recent news. So just wanted to share these data points with you, and hopefully that helps you to better understand the macro side of our economy and make better decisions. Okay, so until next time, we're going to talk about more interesting news articles that I saw recently to better explain even from different angles, right? Like a rental, HPI prices, from like immigration, like all different angles to better explain the economy. So until next time, stay tuned, subscribe, ciao.